Sometimes the market does things that, on the surface, make absolutely zero sense. Well, January 5th, 2026 was one of those days. A major military crisis breaks out, and Wall Street's reaction to basically throw a party and rocket to an all-time high. It sounds crazy, right? Okay, let's get into what really happened. So this was the final number for the Dow Jones Industrial Average, a brand new record. But here's the wild part. During the day, for the first time in history, it actually smashed right through the 49,000 mark. That's a huge psychological milestone, and it all happened on a day that started with headlines of military action. And that really brings us to the big question we're tackling today. How in the world does a U.S. military intervention in Venezuela, of all things, lead to one of the best days the stock market has ever had? It just seems completely backward. But the answer tells you so much about what's really driving the economy right now. To really get our heads around this, we first have to just look at the scoreboard and understand the incredibly powerful story that took over Wall Street on this very unusual day. Here are the raw numbers. Look at that. It was just a sea of green. The Dow really led the pack, jumping a huge 1.23% to that record close we just saw. The S&P 500 got back over 6,900, and the Nasdaq put up really solid gains too. The point is, this wasn't just one or two stocks doing well. This was a broad, powerful rally, all fueled by a very, very specific idea. And this is really the core of it all. The market didn't panic. It didn't sell off. Instead, investors looked at the news about the U.S. intervention and they completely reframed it. They didn't see it as a risk. They saw it as a massive, long-term strategic win for American power and, crucially, for energy independence. So let's dig into that first pillar of the rally, because it was all about geopolitics. It was about Wall Street believing it had just witnessed a brilliant move in the global energy chess game. The buzzword of the day was this, the Donroe Doctrine, basically a new, more assertive U.S. foreign policy for its own backyard. So the military action wasn't viewed as creating chaos. No, Wall Street saw it as the start of a decisive plan to secure the region, kick out rivals like China and Russia, and, this is the most important part, bring Venezuela's gigantic oil reserves back into a friendly orbit. And you can see the result right here. It was immediate. Money just poured into the energy sector. It soared 2.67%, which is 4 times better than the broader S&P 500 did on the same day. Investors weren't just speculating. They were placing massive bets that this geopolitical shift was going to make U.S. energy companies a lot of money. And you can see exactly who they were betting on. Chevron, the only big U.S. oil company with operations already on the ground in Venezuela, jumped almost 6% on the idea that its assets would be safe again. Valero Energy just exploded, up over 9%, because its refineries are perfectly set up to handle the specific kind of oil that comes out of Venezuela. And then you have the service companies like Halliburton, which shot up because they're the ones who would get paid to rebuild everything. But believe it or not, this rally wasn't just about oil. At the exact same time, a second incredibly powerful engine was absolutely roaring to life, the unstoppable momentum of the AI revolution. Yeah, so while the whole world was focused on Venezuela, this huge tech story was breaking. Chip makers like Samsung started signaling that they were going to raise prices for the special memory that powers AI servers by 70%. This immediately sparked talk of a new memory supercycle. And at the same time, the big banks were finally starting to show proof that all their spending on AI was actually cutting costs and making them way more efficient. And this wasn't just wishful thinking. You had highly respected analysts like Mike Mayo at Wells Fargo telling everyone that this was just the beginning. His argument was that between deregulation and these very real AI efficiencies, the huge rally we'd already seen in bank stocks had a lot more room to run. And boy, did the market listen. Giants like JP Morgan and Goldman Sachs hit new all-time highs. On top of all that, there were a bunch of other powerful stories just adding fuel to the fire. You had the government committing billions to nuclear fuel, basically to power all the new AI data centers. Palantir, the defense tech company, got a nice 4% bump after reports its software was used in the Venezuela op. And then you had totally separate big moves, like Novo Nordisk jumping on a new drug launch and Coinbase surging as crypto made a comeback. So you've got these two massive positive stories, energy dominance and an AI boom, happening at the exact same time. What does that do to the overall mood of the market? Well, let's take a look. This chart says it all. The CNN Fear and Greed Index had its needle pointing squarely in the greed section. Now, what this tells us is that investors were in a total risk-on mood. Instead of seeing a crisis in Venezuela as a reason to be cautious, they saw it as just another reason to buy, another opportunity to jump into the rally. And this number right here just confirms it. 14.9. That's the VIX, which people call Wall Street's fear gauge. Basically, it measures anxiety in the market. And despite all the dramatic headlines, the VIX was incredibly low. Anything below 20 is considered calm, so 14.9, that's a market with almost no fear at all. But here's the catch. While Wall Street was popping champagne and hitting records, the real economy was telling a very different story. The latest manufacturing report, which came out the same day, was bad. The number was 47.9. Anything below 50 means the manufacturing sector is shrinking, and this was the 10th month in a row of decline. That is a huge disconnect. So this paints a really complicated picture for any investor, right? You've got this euphoric stock market, but a pretty weak real economy. So how would you even think about navigating this? Well, the source material sketches out two very different paths you could take. Okay, so the aggressive approach is to just ride the wave. You'd bet on the AI boom and that memory supercycle using ETFs like SMH, which tracks chip makers. The huge risk, obviously, is that it's all just an AI bubble waiting to pop. The more stable or defensive play would be to look for value. Think high dividend stocks and big banks that are using AI to get more efficient, maybe using an ETF like XLF for financials. The risk there is that if inflation stays sticky, the Fed can't cut interest rates, and that could hurt those stocks. So at the end of the day, it really boils down to these two competing views. The bull case says this is all real, that U.S. energy dominance is going to keep a lid on inflation, and that the AI boom is going to create a whole new wave of profits. The bear case, on the other hand, warns that this kind of foreign policy could backfire and that the enormous gap between Wall Street's party and Main Street's reality just can't last forever. And that leaves us with a million-dollar question to think about. Was January 5th, 2026, the day the market correctly saw the dawn of a new American-led, tech-powered economic boom? Or was it a day of dangerous euphoria, where investors, just high on AI and energy optimism, chose to completely ignore the very real warning signs that were flashing right under the surface? I guess only time is going to tell.